Hypothetical performance explained. Compliant wording for backtests. When we say hypothetical results, we're talking about performance that was modeled, not earned, with real money. Think of it as a what-if scenario built from historical data or assumptions. These numbers illustrate how a strategy might have behaved, but they're not promises and not evidence of actual profits. They're valuable because they let us teach concepts, stress test ideas, and visualize trade-offs without risking capital. Picture a flight simulator for investors, useful for practice and planning, but it doesn't predict tomorrow's weather. Keep that frame in mind as we separate learning tools from real-world outcomes. Your top priority is clarity. First, avoid implying certainty or profits. No, this will make money. Markets are uncertain, and your language should reflect that. Second, be transparent about limits. Models use assumptions, data may be incomplete, and conditions can change. Say that plainly. Third, help viewers assess risk by mentioning drawdowns, volatility, and scenarios where the approach can fail. When your audience understands both upside and downside, they can make informed decisions. Compliance isn't red tape. It's how you build trust with precise, honest communication. Always state that results are hypothetical or backtested, not realized in live trading. Add the standard caution: past or simulated performance does not guarantee future results. Then specify assumptions and data sources so viewers can judge reliability. Which market data provider, time frame, corporate actions treatment, and any adjustments. If you used proxies or approximations, say so. If there were model constraints or rules, like maximum positions, disclose them. These notes turn a glossy chart into a transparent analysis that professionals can evaluate on its merits. Choose language that describes, not promises. Good. In this simulation, the strategy returned X% over Y period. That signals modeled results and scope. Good. Assumes zero slippage and fees unless noted. Clear, testable, and honest about cost modeling. Avoid promotional claims like will outperform, cannot lose, or guaranteed gain. Those phrases imply certainty and mislead viewers. Prefer verbs like modeled, simulated, estimated, observed, and qualifiers like may, could, under these assumptions. Precision protects your credibility and keeps the focus on evidence. Spell out the entry and exit rules, indicators used, thresholds, and look-back windows so others can reproduce results. Detail costs, broker fees, exchange fees, spreads, and slippage assumptions, because small frictions can flip a strategy from profitable to unprofitable. Specify rebalancing frequency, daily, weekly, monthly, and data timing. Did signals use end-of-day prices, next bar open, or minute bars? Clarify any latency or order type assumptions, market versus limit. Transparent assumptions let viewers evaluate whether the model reflects anything close to their real trading conditions. Walk through the data period and sample size so we know the test isn't cherry-picked. Then describe your walk forward or out of sample process. Train on one window, test on a future window, and repeat. This reduces the risk of tailoring to noise. Address biases directly. Note how you handled survivorship bias, including delisted assets, and look-ahead bias, using only information available at the time. If you performed parameter sweeps, explain how you avoided overfitting. When the method is clear, the results become credible and teachable, not mysterious. If you compare to a benchmark, make it named and time-matched, for example, versus S&P 500, January 2015 to December 2024. Keep currency, timeframe, and costs consistent across the comparison so it's apples to apples. Don't just show returns. Include ranges, drawdowns, and volatility so risk is visible. For fairness, use total return if your strategy reinvests, and match dividends and fees treatment. Consider showing risk-adjusted metrics like Sharpe or Sortino as context, while reminding viewers that all metrics depend on the stated assumptions. Label results as hypothetical or backtested upfront. Disclose key assumptions, data sources, and limitations. Use cautious, non-promissory language that avoids certainty. Share risk metrics, drawdowns, volatility, alongside returns. Keep benchmarks consistent in period, currency, and costs. Note steps taken to reduce bias and overfitting. Invite independent verification, share rules or code snippets when possible. The takeaway: clear methods and honest caveats turn a backtest from marketing fluff into a useful learning tool that respects your audience's intelligence and protects your credibility.